Good morning. Today we're going to talk about investment properties. Some of you may be aware that I have a background in banking prior to getting into real estate 23 years ago. And from that time, I developed a fairly, I'm going to call it sophisticated, but a fairly detailed approach to analyzing investment properties, whether that's a residential property or a commercial property. And I just want to share a few things with you because there's so much that I hear from the general real estate population of realtors, but also people investing. So when I look at, and I'll use a residential property as an example, I don't just look at the dollar return on it. What's the monthly rent? Because what we know in the rental world is that at some point in time, you're going to have to replace a heating and cooling, or you're going to have to put a new roof on it, or a tenant's going to move out and you're going to have to replace carpet. So I believe that there needs to be more detail put into the analysis of these type of properties to truly understand your return. Plus, I think it's really important that we look at the opportunity cost on the money that you invest. If you have to put 20% down or 30% down for the loan that you're getting, that money could be earning for you somewhere else. Right now, there's a lot of ways that you can get 5% on that money. There's ways you can get close to that tax-free. So that needs to be factored in. There's a number of different types of returns on investment property. You have appreciation. We happen to live in a high appreciation market. Not everywhere is that the case. You can go to the Midwest, the upper Midwest. Their appreciation rates are much lower than ours. But I don't think that's what you can count on with an investment property. I think you need to look at the cash return on it. You need to look at appreciation. You need to look at pay down of mortgage and what that property is doing to build equity for you through rental income. I think you also need to look at the tax benefits, the things that you can write off on that property, but also right now purchasing a property and renting it this year, you can claim bonus depreciation, accelerated depreciation through cost segregation. There's just a lot that goes into it. And I see so many people that just want to take the pure dollar for dollar rent income and look at that as the return on investment. That's not correct. And that doesn't give you a full picture of what that property should do for you. Then also on the sales side, people look at the market value and say, well, the house across the street sold for X, I should be able to sell for X. But if you're selling an investment property, the cash return on that is going to impact that price. And sometimes in our market, the value for an income property is going to be less than it may be just to sell the property outright for somebody to move into it and live in it full time. So I just think that there's a lot more detail that needs to go into some of these conversations. The same thing rings true with commercial. So if you have questions, please don't hesitate to reach out. That's what I'm here for. We're here to help you understand the full picture, the full impact of your investment, the good, the bad, and the ugly. Sometimes there's information that we give you that isn't what you want to hear, but that's what we're here for. Please don't hesitate to reach out and let me know how we can help. Have a great day.